It's almost like basketball. You know, when a team is winning, all the other problems kind of fade away. When a team is losing, it exposes what's really going on. That's my sports metaphor to Warren Buffett's, when the tide recedes, you see who's swimming naked. But what I found is when the pandemic hit, a lot of people thought that they had a good measure of their risk and their understanding. But when life punched them in the face, they realized risk goes out the window.
Hello, everyone, and welcome to the NASDAQ Dorsey Wright podcast for the week ending on November 10th. My name is Ian Saunders, and we're lucky to be joined this week by Ari Baum. Ari, thank you very much for coming in and joining us here this week.
Hey, always a great time, always a pleasure.
Yeah. So Ari is joining us for the third iteration of our Risk Series podcast. If you haven't listened to the first two, please do go on and take a listen to those. But we're going to have a great, looking forward to a great conversation today. Ari, a lot of the conversations we've had previously around risk have hit on a lot of different areas, but you come at things from a unique approach relative to the prior conversations we've had. So maybe before diving into the actual kind of content, if you wouldn't mind kind of telling us a little bit about yourself, kind of what you're looking to do more in that financial advisory type of role.
Yeah, so I'm the founder and CEO of Endurance Wealth Partners. It's a complete family office that I've established about 9 years ago after spending what feels like a lifetime or over a quarter of a century working on Wall Street. And what I found over the years is that although I've been doing this for 26 years, for most advisors, that doesn't translate to 26 years of experience if you're doing the same thing over and over again. And by developing and refining a process, I've elevated myself, my practice, and my clients to another level. And it just makes coming into the office very enjoyable every day.
That's great. So you meant being on Wall Street prior to that. What kind of roles? I don't know if I'd actually asked you this before. What other kind of roles were you looking at previously?
Yeah, so prior to founding Endurance Wealth Partners, I was a senior vice president at Morgan Stanley. I was a vice president of investments at UBS Financial Services. I spent some time at JP Morgan, even had a stint as a trading floor manager at the American Stock Exchange prior to its acquisition from the New York Stock Exchange. And before that, back in the late 90s, early 2000s, working at an investment center, buying and selling stocks and executing trades. So, through that journey, you've learned a lot about Wall Street over the years.
Yeah, absolutely. That is you've kind of run the gambit on different roles there around. And certainly, I mean, I know you said experience that doesn't, on paper at least, that looks like certainly sounds like a lot of experience from my end.
Mm-hmm.
So with that, in looking at, so I guess why did that make you want to come into the more financial advising framework rather than kind of continuing down roles on Wall Street?
Yeah, I think just over time on Wall Street, we've seen that evolution. When I came into the industry, everyone was a stockbroker, buying and selling a stock. And you realized through that experience that you were only as good as your last trade, and you weren't building anything meaningful for clients. You were just an order taker, and you were dealing with people on a transactional basis. That evolved to becoming a financial advisor, where you started thinking ahead. Hey, you're investing for a purpose, whether it's education, retirement, purchasing a home. So you try to connect the dollars to a goal. That's evolved to, I'll call it almost being a psychologist and saving people from themselves and the emotional decisions that they make. Most notably, COVID is a great example. No one could have foreseen it, maybe outside of some politicians, but for us laymen, no one saw it coming. No Wall Street analyst, no economist, it just occurred. And what we found was a lot of people were making emotional decisions that they thought was good at the time, but lacked the perspective, of life experience. So, people were taking money out of their IRAs and their 401ks because they didn't have liquidity, and they were paying the taxes and the penalties. They didn't have that sounding board or that planner to say, here's the fund for the rainy days. So you don't have to go out and pay these penalties and fees to access your own money.
So do you think that and just I guess continuing down this vein a little bit, do you think that the pandemic induced environment maybe amplified some of the kind of concerns that were already kind of permeating throughout broader kind of public aspect of financial advising, or what kind of role do you think that played?
Yeah, I think it was a wake up call for the industry that, you couldn't just be the asset grower. I'm going to take your money and I'm going to, invest it into, the market and try to outperform. And, it's almost like basketball. When a team is winning, all the other problems kind of fade away. When a team is losing, it exposes what's really going on. That's my sports metaphor to Warren Buffett's, when the tide recedes, you see who's swimming naked. But what I found is when the pandemic hit, a lot of people thought that they had a good measure of their risk and their understanding. But when life punched them in the face, they realized risk goes out the window. So I found that by having a deeper conversation with the client and understanding both sides of the balance sheet, we were better suited to prepare them for the curveballs that life threw at them. And we were able to respond to it versus just reacting at that moment in time.
Right. Okay, that makes sense. And so talking about the kind of COVID environment, I mean, it's very natural or easy to understand what the risk was with that environment, right? Were we ever going to come out of lockdown? Was that ever going to happen? But I guess more broadly, taking it back from taking a few steps back, when you think of the word risk, and whether it's portfolio management, whether it's client management, I mean, what's the first thing that comes to your mind when you think of the word risk?
Yeah. So the way I define risk is in three buckets. There's principal risk. No one wants to lose their money. The second risk out there to a person is liquidity risk. If I buy something, can I get my money out of it? And then the third risk is inflation risk. Leaving your money under the mattress is going to lose you money over time. Now, what I would say with those buckets of risk is some buckets are filled up more than the others. For example, and right now, there are treasuries and money markets that are paying 5-ish% versus years ago it was paying 0%. So you have a better tool to combat the inflation risk. And hopefully inflation continues to trend lower. What I found with principal risk is that no one wants to lose money, but most investors understand that investments do go up and do go down, and that by having a diversified portfolio, you reduce the likelihood of an account going to zero if you had put all your eggs in one basket. So diversification can offer a certain measure of protection. What I found, what really affects, and also I'll tell you like this, when a stock goes up, people don't care about risk because the stock is going up.
Right.
When the stock goes down, that's when they're like, oh, wait, the risk and this and that and the other. So I'll say that risk kind of ebb and flows with a person's emotion. And then the liquidity risk is why I believe most people or most investors are not successful in the market, because they tend to invest money without thinking ahead what they might need it for. And it's typically like what we saw during COVID. The market dropped very rapidly in a short period of time. And in that period of time, people lost their jobs, or they got laid off, or their business revenue declined because everyone was on lockdown and they had to pay their bills. So where were they going to get the money? They had to sell, and they're selling when the market is down, and then they missed the subsequent recovery. So that to me is a very important consideration that people tend to overlook.
So I guess in looking at each of those risks, I mean, while there are portfolio management kind of aspects, they all seem more geared toward risk associated that a client would associate with you managing their portfolio, right? When you're communicating that, I guess, diving into that a bit deeper, is it more important to communicate those that you're aware of those risks ahead of time, or react to them when they're happening real time?
So I found that, what's the old adage? A an ounce of prevention is better than a pound of a cure.
Okay.
I hope I
I love that.
didn't butcher that. but but if you think about it, it's about preparing people for what's to come.
Okay.
And if unfortunately or fortunately, clients come to us because they see us as professionals. So they tend to give us control because they say, you know better than me. You're better able to navigate this than me. Same reason why you go to a doctor. Yeah, you're guilty of this as I am. The worst thing you could do for yourself is to go onto Google and try to self-diagnose yourself when you have a symptom.
No, WebMD is the worst thing I could look at.
Exactly. It's horrible. Like every time you type in something, you think like you've contracted some rare disease and it's the end of the world.
Yes,
so instead of going on Google and trying to self-diagnose, you go to a doctor because he or she knows better than you. And clients come to us because they believe that, and we should know more than them. Where it kind of goes off the rails is that if you don't set the proper expectation for what kind of road or sea that boat is going to sail on, is it a smooth seas or is it going to be choppy and bumpy? If a person is expecting a smooth ride, I'm going to give you a quick analogy of a story from my honeymoon, which
Are we
which
sure
you
we
may
can keep it
appreciate.
rolling?
We can keep it rolling for this. And so I'll give you a perfect example. When I got married with my wife, we went on a honeymoon and we were down in St. Martin. And while in St. Martin, they had those tours that went to the other islands. So one of the islands that I was going to was St. Thomas. So we saw the ferry. They're like, oh, it's $20 to go to St. Thomas with the ferry. It's 20 minutes. It's enjoyable, open ocean, water. Things are great. And right next to it, there was a little table with a guy sitting there, and he's like, oh, if you want to fly to St. Thomas, it'll take you 10 minutes. It'll cost you $100. I said, okay, 20 minutes versus 10 minutes, $30 versus $100. Being the good steward that I am with finances, I said, let's go in this enjoyable boat ride. About 5 minutes into the boat ride, once we got out of the bay, guess what happened? Open ocean, right? Mm-hmm. We had 10-foot swells bouncing up and down. We were sick to our stomach and we swore never again. And when we got off the boat, we said, we're not taking the boat back. We saw another table with another chair with a guy sitting there. He's like, oh, you want to fly back to St. Martin? $250 a person. So, expectation coupled with, capitalism at its finest. So had someone have warned me prior that the seas were rough, I would have just hopped it for the plane. Because I was expecting it to be smooth, I ended up having a bad experience and I ended up spending a lot more money after that. Same thing with investing. So we have to lay the groundwork for what our clients could expect.
Right. That makes a lot of sense, I think. So within investing in different kinds of portfolios or different kind of aspects, right? The point that you mentioned earlier about clients only as good as your last trade, kind of where you're coming from before. Do you think that aspect still kind of permeates into the financial advising framework from people just being too return focused in general? Or I guess taking the question a different way, how does everyone now knows what the S&P 500 is, and is it difficult to kind of benchmark yourself to something else or benchmark the portfolio to something else when that's really what's flashing at the top of like CNBC and everything every day?
I think that if you're a financial advisor who tries to model himself as the next Warren Buffett, and your claim to fame is your investing skill set, then the only fair benchmark or comparison would be an index such as the S&P 500 or some other, index, depending on your investment philosophy. What I found where we really add value is we look at investing as a tool to help you get from point A to point B. Investing is not the end all be all. So our focus is more of preparing you for the curveballs that life is going to throw at you. For example, we know, that I'm going to pick on you for a moment. When I, because I know you, when I look ahead at your future, right? You're going to get married, you're going to have kids, you're going to want to buy a house, you're going to want to retire and pay for your kids' college education all in the future, right?
Hopefully, yeah.
Hopefully, preferably in that kind of order, right? In case mom is listening, right? So that's the order. So we know that we need to prepare for those things. So we know that we'd have to save up for an engagement ring. We know we'd have to potentially save for a wedding, a down payment on a house. So being that you have those goals, you can invest money to achieve those goals. So, I know I'm picking on you now, but you wouldn't take money that you may have saved up for an engagement ring and dump it into the stock market if you know you need it in the next 6 months, right? You just wouldn't be wise, unless you had some magical lamp that would tell you. Right. So by separating money into different buckets, you're able to simplify things for clients. So that way they have a better control of their risk. So if you were buying a house in the next year and the money for a down payment, we would all agree that that money should not be in stocks. You'd want to keep that somewhat conservative. So what I would, so from that perspective, the client's expectation is I'm not looking for him to show me a 20 or 30% return on my money in that short period of time because I'm not willing to accept that risk. Because on the flip side, I don't want to risk losing 20 or 30% of my money.
Right.
Versus
right.
If you're saving for retirement in like a 401k and you have 20, 30 years in front of you, you actually want that volatility. That's an appropriate place for it because you know that over 20 or 30 years, stocks should outperform bonds or cash and all that others, all the other types of investments out there. So when you separate or segregate the money into different buckets, you have a better understanding of the risk for each bucket that you're willing to take. And you're reducing the shock value that if the markets go down, you're not sweating about your 401k that's 30 years away from now. In fact, you're excited when the markets go down because now you can put more money into it. Versus if you were buying that house in the next 12 months and the markets go down, you're like, oh my God, can I now afford that house because I lost that money?
Yeah, that makes sense. So when you're looking at different kind of buckets and different kinds of different kind of clients that you're looking toward with the money, I mean, what kind of processes, what kind of tools, I guess, are you looking toward to help you manage that risk? So whether it's tools to help you communicate with your clients or the conversations you have with your clients, but more so when you're looking more risk in the market, right? What are you using to help manage that kind of risk?
So I'll preface it by saying, what we just spoke about, all those different buckets of money, I'm going to put them into silos, and then I'll break it down. So think of, bucket number one is, we want to make sure that our clients have anywhere from 3 to 6 months worth of expenses as a reserve. It could be checking, savings, CDs, short-term treasury, whatever it is. That's a non-risk bucket. Because your time horizon is that you might need this money in the next 3 to 6 months. So if you, God forbid, lose your job, or the sink breaks or the roof leaks, you have liquidity. Bucket number two is about 1 to 3 years worth of expenses. And what that is that maybe you're planning a big family trip, maybe you're planning a wedding, maybe you want to buy a house. Same thing, money that you don't necessarily want to take risk with by investing in stock. Again, maybe it's CDs, treasuries, whatever it is, maybe slightly longer maturities because you have that window. Bucket number three is what I call your wealth building bucket. That's the money that you want to use in the future to build it up so you can live off of it when let's say you want to retire. So in that bucket is where you might house your 401ks and IRAs and all the other stuff. In that bucket, it is so important to remove the emotion from investing. So what I personally love to use is the signals in NASDAQ Dorsey Wright to help me cut through the noise of, dare I say, the media, because when the markets are down and the pundits on CNBC and Fox and Bloomberg, and they're talking about the end of the world, what does it do to people? Scares them. And then what do people do when they're scared? Fight or flight. And they, typically they fight or they fly when they get scared, and then they sell when things are down. When the markets are up, what do you hear on CNBC and Bloomberg and Fox News and all the news channels? Everything is great. The markets are high and all that. What happens to a client at that point? Then they want to buy.
Right. So for full disclosure, you do use the platform there, but I think that brings up a good point just about technical signals and maybe diving into a little bit, do you think the adoption of that with your clients, is that something that I feel like maybe 5 to 10 years ago, the technical quant in the room was thought of in a corner with maybe glasses on, crunched over his computer, and no one wanted to talk to him. Is that something that you feel like is more easily adopted by the broader public, looking at technical aspects? Is that something that people seem to make sense with now?
Yeah. I think, how it's evolved over the years, is that because with, computers and software and all that other good stuff, versus, drawing it out on graph paper or just looking at a chart on a stock. I think what people have a great ability to do now is look at the technical signals that they're reading off of the screens, compare that as an overlay to the market performance, and compare that to what they see on the news. And, what I found is that it really helps you cut through the noise of what's out there, because when you look at a signal, it's unbiased. There's no political agenda. There's no, kickback coming to a technical signal. It's not like a hedge fund manager coming on the news and talking about how great a stock is because he bought it 6 months ago. It is black and white. It's almost like, I'm embarrassed to say this, but you'll tell me who quoted this. You are what your record says you are. Who says that? It wasn't Vince Lombardi. Maybe. All right. So, so what it is that, part of what I love about sports is you are what your record says you are.
Right.
If you have a good record, you're a good team. If you have a bad record, you're underperforming. So with the signals, it cuts through the story behind it, and it tells you exactly what it is. And over time, you're able to see the correlation between the buy signals and the sell signals, the periods when the markets are oversold and overbought, and then you can invest accordingly.
Right, that makes sense. And I think as well, just how we like to look at it as well, just tying it back to communicating that process with people seems to resonate very well. They know, to your sports analogy, they know you have a game plan, right? They know that things might be good now, might be different in the future, that you have some kind of plan to look toward when things are a little bit different than they are now.
Yeah. I'll add to what you're saying. I think one of the things that my clients really benefit from is that they know exactly what to expect, both in the planning process and in the investment process. So I'll use an analogy of McDonald's. Why do people love McDonald's? You eat at McDonald's?
Their fries.
Once in a while. And the fries are great, right? But is it really, is the burger like some oh my God, amazing, the greatest burger I ever had? Or is it that when you walk through McDonald's, you know exactly what to expect? You know how the burger is going to taste, how the fries are going to taste, and the process for ordering and the payment, everything is there. It's a system. That's why they could have an 18-year-old as a manager at McDonald's, because they've refined that system so much. Same thing when it comes to portfolio management. I tell my clients, we have a formula that we use for investing that removes the emotional mistakes that most people make. And because we have that system, it's not guaranteed that it's going to outperform or underperform, but it's going to remove the emotional biases, which is one of the reasons why most investors are unsuccessful when it comes to investing. And when you communicate that to a client, many of them that join you will feel that, hey, you know what? I'm coming to you because I made emotional mistakes and it cost me money. You're not going to make the emotional mistakes that I'm making. So that's why I'm entrusting you with my money to do a better job than I can do. Because you could buy the S&P 500 tomorrow, and that's a great investment. But if you're going to make the emotional mistakes of selling it when it goes down and then buying it when it's at its all-time high, your investor return will be very different than the investment return. And
Right.
as professionals, we can narrow that gap.
Right. That makes a lot of sense. That makes a lot of sense. And I think that frankly that makes me want to go get some McDonald's too. I know it's I know it's a little after lunch here, but you got me hungry again.
Mm-hmm.
But no, I think that makes a lot of that makes a lot of sense. And I think this is the whole conversation has been pretty helpful, at least to understand different ways to look toward risk, especially from a client perspective. Because I think when we're sitting on our end behind the computer, writing research, working with the models, that type of deal, the end client can oftentimes kind of get lost in the thought process. And I think that's always a helpful part to keep in mind for everybody that might be listening in.
Yeah,
So,
I agree. You know what? It's, we always have to look at things through the lens of a client,
right.
because you could have the greatest research in the world and the greatest platform in the world, but if you're your own best kept secret, who's it helping? And if you're forgetting why you're doing what you're doing, clients aren't going to stay invested through that process. So you have to communicate it with them, you have to articulate it, and you have to keep reinforcing it.
That makes a lot of sense. Well, Ari, I think that we can probably look to land the plane here, as we frequently say when we're bringing the podcast to a close. But I want to thank you for making the time on this. So we're recording this for those that are listening on Wednesday. Podcast still going to be coming out there on Friday. So thanks for making the time in the middle of the week. You have any plans this weekend, Ari?
Yeah, actually, coaching my daughter's high school's cross country championship meet.
Oh,
So
wow.
that should be a lot of fun. So I get to yell at kids to run faster.
There you go. That sounds like certainly an exciting weekend. Well, good luck. Good luck to you as the coach, and good luck to your daughter as the competitor. And thank you very much for everyone for tuning in this week. And we look forward to having you back again next week.